Okay, well, the little blue button on Zoom would suggest that we're recording, so we can kind of call the order. Yeah, if you could kind of keep some semblance of minutes, we can put together our notes later on. So it's 6:02 and a meeting of the RPAC for June 27. Order. Yes, I'll go ahead and take some roll. Tom Schulte's here, and Carol.
Yep.
Dalvin here, James Young. That's all right.
Yes, can you?
Yeah, oh, yeah.
Yeah.
Understood. Okay, so then what we want to do is approve the minutes from the March 7th meeting. So I need a motion to approve those, or some questions.
I'll second.
Okay, thank you. So Amy and Cole, so we're approved on the minutes. So we have a couple of items here for which Brian is going to feature prominently. So thank you, Brian.
Of course.
First is to talk generally about our investment performance. Any rebalancing that might have need to taken place. I say that with some relative awareness.
Yes.
And also maybe to talk about some of the exogenous market shocks that we might have gotten since last time we talked. And I remember there was the whole uni drama over the debt ceiling and some other things. We want to just kind of understand how that actually affected where we were and how people were talking about it might have affecting and where it kind of all came out, if there were any sort of lessons learned or things that are notable in that respect. I think we all have on our tablet, Diane sent around a copy of Brian's presentation materials, but maybe Brian, you can share your screen too.
Okay. Let me do that. I'll pull it up. Let's see. Okay.
I'm just saying, that's an interesting thing to look at.
Yes.
I'll try sharing my whole screen. I don't know if that duplicates the. Does it? Do you see the presentation?
Yeah.
See it now.
Perfect.
Okay. Now I think if I shrink it on my end so I can keep the video up to see you, does it make it smaller?
Yeah, a little bit.
But we
Okay.
won't have-
Yeah, we got it on our screen.
That's really good right now.
Yeah, that's good.
Okay. So yes, so because I have it full screen right now, I can't see any of you all, but so I'll kind of just listen for cues, or maybe I'll try to shrink it a little, but not too much, and I like to be able to see you all as well. Yeah, thank you for kicking it off as far as topics, Tom, and I know there may be an additional few to talk about, kind of like other best practices, other towns, IPS. But if we were to start just with the markets, I'll do that and I'll recap it quickly. But there's a few other things I put into the presentation to jump, and we can jump around. One is I have the absolute performance for all three plans, but then I wanted to share some peer performance against a broader OCIO, outsourced chief investment officer universe. The last time I showed it was probably a year ago. I also put in some forward-looking expectations of what the plan should do over 30 years. That's something we also revisit from time to time with the actuary. And then I necessarily won't go into the manager oversight section unless some kind of questions come up about active, passive, and outside managers. And then I have some fun pages. So, and I can address your questions maybe. First off, I'm here on page 4. This is just a high-level recap of the market, of the broad indices, but in some ways it mirrors what's everything in the portfolio, because the portfolio is indexed to the major asset classes as well. So really, I think it's been quite a strong year and much stronger than many had expected, since we had so much of an increase in rates from the Fed, and really so many, including ourselves, coming into the year, were predicting a recession. So on just this page through May 31st, you see
Is
US
that
stocks. Yeah,
just year to date, is that 12 months? Is that 12 months?
this is, yeah, the solid green bar here is year to date, calendar year to date, and 1 year's, last 12 months is here in yellow.
Thanks.
So
Oh,
we are basically close, or have erased, negative gains in the equity markets, not so much on the fixed income markets yet. But so year to date, calendar year to date, 8.7% for US equities, and international stocks up 4.6. That year to the 1 year basis through the end of May, you see now US stocks are positive after being down, close to, I think it was 19% in 2022 calendar year. Have non-US stocks negative 1.7 on a 1 year basis. Fixed income, just briefly, because this was the shock of 2022, not in the sense of a shock of once rates increase, it's a negative relationship between increase in rates and price performance. So it was just how bad bonds were last year. So to recap, 2022 was the worst year ever for fixed income investments. But here on a year-to-date basis, fixed income, this is the broad Bloomberg Barclays aggregate, up 2.5%, but still on a 1 year basis, negative 2.1, because fixed income markets were down, I believe, 13% in 2022.
So,
Yeah,
sorry, the numbers of being down 2.1%, that's from May 31st, 2022 through May 21st or 31st, 2023, right? That
yes,
doesn't reflect the losses in the beginning half of 2022, right? Which
correct.
contribute. Yeah, if we're up, say 8.7% on the equities and you were down 19%, you don't get back to only being ahead 2%.
Yes.
If you reflected the whole of 2022, we're still down a significant number, right?
but wait, when did they start raising rates? Because that's when the bonds got crushed. Because was it, I forget, was it the beach, it was the middle of 2022, right?
The beginning of 2022, yes. Yeah, we've had 10 rate hikes, I believe, since they started the rate cycle.
Okay.
Right.
Okay. Thank you.
Yeah, of course. So in there, Tom, I'd probably address your first question kind of around debt ceiling and shocks. So really what the debt ceiling is, we've seen these standoffs in the past. We had it a couple months ago. And really what that leads to is kind of uncertainty and more volatility. But we weren't forecasting any kind of, dramatic pullback in the markets as a result. It was just more that uncertainty. The market's never like that. So we really got through that. We're still in the midst of a lot of geopolitical, risks, and namely in Russia and Ukraine. But everything is, and the economy is actually holding up pretty good in light of all these interest rate hikes. So I don't know if I'm missing any big shock, but it is, I think, surprising that the market is up so much. It's up even more, through the end of last week, or even, year to date through June 26th. But the market leadership has been quite narrow, and I'll talk about that in the next two slides, just very high level. It's really come from a select number of stocks, and follow the news, and it's all of this AI, artificial intelligence craze, stocks like Nvidia. So the market leadership has really been in these growth stocks, which is really on the next page, page 6. It's in the IT sector primarily. So you see on a year-to-date basis, the tech sector is up over 35%, and really communication services, that has some of the media names, but really it's pretty weak across most of the market. So the market leadership has been quite narrow. Also in there is Yes, as a result of the stronger equity markets this year, we did have one rebalancing that we undertook, and that was for the OPEB plan. And as a reminder, as far as the tolerances that we set for rebalancing, it's plus or minus 5% at the asset class level, equity and fixed income. And I can start to go into the pages to show that. But let me pause there. Did I address the first couple of questions, Tom, or are there other questions that you should talk just about the markets? And
Right, so it was just more the drama and the lack of, sort of reliability, right? And the marketplace is all getting nervous, and what could it mean, and would we really default, and, all the kind of Janet Yellen telling people in June, I'm gonna have to do X, Y, and Z. It was all a bit of a mess, but
yeah,
and then supposedly, if I read this correctly, that the arrangement they entered into allows them to raise the debt ceiling through this cycle and the next one, right? And yeah, he got himself through the next election.
I think it got it through the next election, right?
Yeah, so that kind of bodes well in the sense of, I suppose it's a small universe of things that can fight over for the next couple of years.
Right.
But all right, I just kind of wanted to know whether or not, all of the anxiety that led up to that and some of the movements in the markets are such that, maybe other funds or other investment committees, approach that kind of volatility risk in a different way. But it seems kind of like, hey, you just gotta, hold the line, steady as she goes, don't worry about this, we have this investment policy, we have our current allocations, and, let's just let it rock. And, at least as many times as that could work to your detriment, it's probably gonna work to your benefit.
And it's just in a long run investment.
I'm
Right.
kind of with fiduciaries here, we have to, kind of take that view.
Same advice applies to your 401k.
Yeah.
And so, when you start getting nervous.
Right, so
Right.
that's helpful, Brian, and I do appreciate the color here on how narrow the rise in the equity markets has been.
Right.
Hey,
Right.
I remember, Brenda, I can't remember, in the whole equity market, I mean, that's a big question, but you were talking about certain sectors, because I feel like all of us are overly concentrated in tech, like how much of all of the equity market is tech? Because I think when I look through my own stuff, it's like, if you have an index fund, it's got X% Apple, X% Meta, X% this.
Right.
So
Right.
you're taking the whole equities universe says 100. Is
Right.
it 25% tech? And in that tech, how much of it is these behemoths? Do we know?
Yeah, yes, I couldn't cite it off the top of my head, but I can get that pretty quickly. But yes, the tech sector is over 20%. I want to say somewhere between 20 and 25%. And often there's charts, and I can look for one, is like the top 5 or top 10 stocks, as a percentage of the S&P 500 has certainly, now that's shifted maybe 2022, 2023, but the top 5 names or top 10 names, the concentration that they make within the S&P 500, at least a year or two was at basically a record. And I don't know if it's sold off a little bit or, a different stock has replaced it. But the big stocks have really been driving the market. And then just as that relates to the broader global markets, and one reason the US markets have done better than international is tech is a much bigger share of the overall US equity market than, say, outside of the US. And that has certainly led to stronger outperformance of US, not just here in 2023, but even the last 10 years. That's been a big contributing factor to why the US has outperformed international markets the last 10 to 12 years.
And then if you take a somewhat more expansive definition of tech and include what I'll loosely call tech related. Right?
Yes.
So sort of old school brick and mortar, I'm gonna build at least data centers. That's probably just your regular old local real estate guy who's, building data centers, but it's all dependent on.
Yeah. It's, well, I guess, I mean, if you put back probably 7 years, it was industrials, right? So it was,
Right.
this industrial.
Everybody wants to do tech companies, because of the valuations.
Right. But I'll be glad to I'll send all 11 sectors of the total market, just so you could see the weights within that. Yeah, but I don't have, I don't want to
Yeah, that's-
distract us from the broader perspective, but I'm glad to send that.
We have index funds anyway, right? So it's covering the entire market.
Actually,
We're not.
You know what?
Are-
Maybe maybe
But
I can
they're-
answer that question. Yeah, thanks, Calm.
Yeah,
Yeah, so,
but we don't try to,
Sure.
target those segments of the market,
No.
at least as a town, right? And say, well, we're gonna
No, no,
invest in
yeah.
large.
No, I think as a data point, it more explains why we are where we are rather than going to guide future decisions.
Actually, Calm reminded me, can you see my screen again? Is it big
Yeah.
enough?
Yeah,
So I just flipped to the back of the presentation where I included the fund pages, the US allocation is in this Vanguard Total Stock Market Index. It's 3,900 securities. It's the entire universe, right? So here's tech. It's now 27%. This just to be clear, it's not the S&P right here. This is the entire market. So tech is, you could see 27%.
and that's ignoring how much tech and healthcare and,
Yeah,
it's-
and you could see right here on the top 10, like look what it's dominated by: Apple, Microsoft, Alphabet, Facebook, Amazon, Nvidia. That's more recent, given that they're up 400% just year to date. Tesla doesn't get thrown into the IT sector, more of consumer discretionary as an auto company, but we know that a lot of the hype around that is kind of like their technology as well. Meta. So this top 10 is just dominated by tech.
Yep, yep.
Mhm.
Okay, sorry for the distraction, but it is interesting.
yeah.
No, it's all relevant to the performance of the markets and just that it's been pretty narrow. So, Tom, I was just thinking of so many things, but yeah, the biggest market stress probably this year, and it kind of came and went, but it was just the collapse a lot of the banks. Silicon Valley Bank,
Right.
First Republic. So that was probably more of a stress in the market than what was even happening with the debt ceiling, and that was kind of in de facto as acting as like a rate hike because it creates tighter lending standards from the bank. So that that was the main story probably earlier this year, more so than the debt ceiling.
Yeah.
Yeah.
It's like old news, doesn't it? Right?
Unless it's a regional bank.
Yeah, well, I was gonna say, yeah.
And my little friends are good.
Right, they're still losing sleep in the regionals, yeah. No, like I totally agree, and it certainly has, it's tightened up those markets, almost in a way that a rate hike doesn't, right? The rate hike just expensive, where the other ones are kind of like, if I get the report, this is not performing well, so I'd rather not make a law.
And it kept them from
Right.
hiking.
For sure.
And that's probably why the Fed went on hold the last meeting, but later in July they'll meet again. And I'm looking forward now, but we're still expecting at least one rate hike, just due to the stickiness of wages and therefore inflation. So even coming into the year, and this is all published data you can go back to, where we differed from the market coming into this year was we were not expecting any rate hikes, where there was, if you looked at certain data and in the futures market, the market, broadly speaking, was expecting some hikes coming into the year.
Yeah.
So if I were to go through the three plans, and thanks for the questions. I'm glad to jump all around, so it's fine. I think we'll still be able to cover everything. So what I have up on page 8 is the pension plan. So again, these are calendar year numbers. So year to date, this is kind of following some of the other data, up 5.7% on a year to date basis. On a 1 year basis, we're almost there to the end of the fiscal year, but just negative at 0.12%. So a lot of that has come of the negative market returns have come off from 2022. If I look out, and this is kind of relevant, I think, to the broader performance, thankfully, and I'm certainly grateful as long as I've been working with you, but the relationship goes back to all the way almost 20 years, right? And looking at that since inception number, I think is relevant in an absolute basis because, while our discount rate for the actuary right now is 6.625, in the past years, it was higher. It was, 7 or maybe even higher than 7 if you went back a decade or more. But that absolute return number is pretty strong in relation to just the broader markets and where the discount rate has been set. And I think that that's partly reflective of how strong New Canaan's funded status is. We'll come to that later, but the funded status of the town's pension plan is still over 100%. And I got an update from another actuary just this week. So the funded status for the 100 largest US public plans, that's dominated by the states, the average funded ratio is 73.7%. But even, and I do have this in the deck, even when we come to the towns within Fairfield County, New Canaan is certainly in a strong position.
I think you showed us last time, I think it was Greenwich and Darien, they were very strong.
They're all.
Some of the cities were weaker, right?
All the Connecticut AAAs are basically funded,
Mhm.
fully or over funded.
Right.
They just are.
Yeah, it's an enviable position for sure.
Yeah.
Right.
Hey,
So
Brian, on the top of that chart, we have the, from inception, is the composite benchmark, is that how the whole market did since inception?
Yeah.
So by 30 basis points?
Yes, so I'll explain the numbers. So year to date, the absolute performance 7.6. This net number is after taking out Vanguard's advisory fee. So then that's what is this net number, 5.67. And then the composite benchmark is this 5.58. And that is made up of, basically, this is your target asset allocation. So these are the weights in the composite benchmark, and that mirrors the policy targets. And, in the short term, any difference between the absolute and the composite benchmark could be due to one of two things. One is any type of, cash flows, because we get cash flows in and out. And then two would be, this is more pertinent to the international piece, but fair value pricing, or that's just referred to is, when markets close overseas versus when the index provider closes. On any given day, those two numbers can be different, and that's what's referred to as fair value pricing. That only affects performance or relative performance on a short-term basis. It washes out over time. So yeah, that would really namely explain any different deviation between the town's performance and the composite benchmark.
We're 30 basis points above.
Over the.
We do get to invest for 20 years.
Right.
I mean, compounding interest, man.
Mm-hmm. So we do have regular cash flows from within the pension plan, and we always use those cash flows to rebalance back to the policy targets. And that's why you see that the current asset allocation is very close to those policy targets. I'm gonna just scoot forward to the OPEB plan on page 10, and this was at the end of May, but we don't really have cash flows, certainly not distributions. There's maybe an annual contribution into the OPEB plan, but those kind of can drift more because we don't have regular cash flows. And so at the end of May, equities were overweight by 4.4% and vice versa on the fixed income side. But in June, because of the strength of the markets, the equity markets, we moved to being overweight US equities or equities as total more than 5%. So we rebalanced specifically on June 20th back to the policy targets.
Right. So Diane, I have a question. How often does the town actually dip into these accounts to take money out to pay retirees?
Well, the pension is every month.
Every month.
The
Okay.
OPEB, we have not touched yet.
Mhm.
We're gonna start.
Right.
with
Okay.
that.
Yeah.
Yeah, we're gonna start with the pensions every month.
So it's every month. I was just thinking about the time, looking about. So it's on a beginning of the month or end of the month on a regular basis.
Yeah.
Okay.
When did we get, when did we change from the defined, this is defined benefit plan, right?
There's
So this is gonna, like, just,
still active people in it.
Yeah.
So it is closed to,
Those
yeah.
new-
It's been a
no-
while, but I think it's still open to, is it police and fire?
Police and fire,
So that will always be active,
yeah,
and then everyone else, so.
yeah, police and fire is a small number of people.
So everybody else is defined contribution
Yeah,
at this point.
Yeah.
Well, yeah, or they're more 401k.
Yeah, that's right,
Yeah.
yeah.
So I mean, yeah, this exposure is gonna just eventually just be limited to the firefighters and the house.
So you know, the asset allocation between the pension and the OPEB is the same, but you know, the performance can differ just slightly because of those different timing and cash flows. So yeah, so here the pension 5.7, and then on the year to date, the OPEB was a little bit stronger because the equity allocation grew to a higher level and equities have done better. So yeah, you see on an absolute basis 5.88. But
And,
should I go back?
The inception performance on the OPEB, a little bit closer to the benchmark, kind of like red on. Yeah,
Yes, yeah, in a shorter time frame, you know,
right.
OPEB trusts are more recent phenomenon, kind of like not every town has even funded an OPEB trust, but yeah, so different inception date.
Got it.
But yeah, it's pretty much right on top of it.
So most
And-
towns pay. They're all fine.
Yeah, unless you're a really highly rated and wealthy town, most of them have almost no funding. I'm not necessarily Connecticut, but across country. It's just a current liability they pay.
And then I just have here briefly on the Mildred Marsley Trust. So up a little bit more, the equity allocation is just slightly different, just slightly higher. It's kind of a 2/3, 1/3 portfolio allocation. And so that's why you see a year-to-date return of absolute return of 5.96, which is slightly above the pension and OPEB, but all within the bands. And this plan typically pays out, I think it's twice a year for the scholarships. That's really the only cash flows we have is usually out.
Hey, can you remind me how much does this kind of stay as a corpus and we pay out just the earnings on it, or is it getting paid out over time? The base on the scholarship fund, I mean,
You know what, I don't know.
yeah, I mean, so I don't know if we're just paying out the earnings or whether it has.
We're chipping in or whether,
Yeah, or if that's, I don't know, the structure, yeah.
I believe the policy is to pay out any income. So
Yeah.
it's, and you know, dividends, interest. So it's any income, because a couple of years back, we had some discussion around, you know, should we shift the portfolio to high dividend yielding stocks, you know, in order to increase it. And, you know, in order to increase the payout, because that's what it's usually just the income that's thrown off of here. I don't think that we've touched the corpus.
All right, so it's in perpetuity, yeah, okay,
Yes. Yes.
thank you.
Not requested, but I did put it in because it's probably been a year or so since we've seen it, but I always like to at least once a year just show the total fees paid by the town. And it's really 3 different pieces. So, you know, it's a declining asset it's an asset-based fee as far as determining the investment management fee. So there's the 3 fees that are borne by the town. So it's the investment management fee, you know, for the advice, the portfolio management. So 6.2 basis points or 0.062%. So what that equates to a dollar amount is 107,000. This is all on an annual basis. I showed some peer data about a year ago, but looking at this versus the broad universe of other OCIO providers, I would still say that we're in the lowest decile as far as that data we've seen from outside consultants, whereas other plans in that 100 to 250 million asset size typically pay fees 10 basis points or more. And I'm glad to share that data again. It's from a third party consultant referred to as Cerulli. So that's the investment management fee. Then there's 2 other fees, you know, for the trust services of the plan. So just 1.7 basis points, and we do the pension payroll, which equates to 1.5 basis points or 0.15%. So those are the three fees that were what you refer to as like out-of-pocket expenses. It's paid by the trust. So that totals the 162. Just for transparency, we showed all the fund expenses. So the average weighted expense ratio for the total portfolio is 4.3 basis points or 0.04%. That just shows up in fund performance. That's not a hard fee paid by the town. It's any fund investor would pay those fees. So the absolute fees from either the investment expenses or the advisory side are, I would still say, very, very attractive, very competitive within the global landscape.
So Brian, does Vanguard negotiate with individual towns or cities? Or is this a standard that is applied across the board?
It's a standard fee schedule, yes, for all clients, mainly based on, size of assets. As you could see, like the different breakpoints up here, this is how the actual schedule shows in the contract. So
And have
it
these fees,
depends on the assets, yeah.
have these fees changed over the years, or they've been the same for the last 20 years?
So they changed or they increased about a year ago because they hadn't changed for the past, say, 20 years. Not that I've been on the working with the plan for 20 years, but they were unchanged for so long. And maybe it was a year and a half ago, kind of discussed with the committee, and then the fees came up because just they hadn't changed in that 20-year period. And that was the same across the board. It wasn't specific to the town of New Canaan, is that we had repriced all of our advisory clients because we had held fees constant for so long. So it hasn't decreased, but it stayed the same for a long time. And about a year and a half, it increased. I don't recall what the delta was off the top of my head.
You probably don't want.
Yeah,
Unless it,
I do remember the discussion that they hadn't been raised for quite a while, and I think at that time, Brian, you had shared some benchmarking with us at the time that they raised it, so we were all comfortable. This was in the zone of what other similar situated towns were looking at.
Yes, in that previous presentation, yeah, would have benchmarked it against other OCIO providers. And it was still within, even with the increase, it was still in the lowest, say, decile of providers.
Yeah, that's what I recall.
So is our total all-in everything fees, is it basically that almost 8 basis points, or did you say it was averaging more than 4.3? I'm just.
Yes. Yeah, this 7.9 basis points, which equates to 162,000. Yes.
And then all of our performance is net of that. We see,
Right.
we see it. Okay, thanks.
Yes. Yes.
And
So then,
so
then just kind of staying, we talked about.
That's great.
Well, we were just noting, Brian, that in your footnote here on this page, you sort of helpfully had mentioned that there's approximately 350 participants who are receiving benefits.
Oh, yes, because the pension payroll fee is that there's a flat fee and then there's a per participant fee, right? So some plans might only have 100 participants. Some pension plans might have 10,000 participants. And so there's a well, yeah, you see the footnote, right? The flat fee plus a per participant fee.
do the participants in the plan have access to a website where they can check out their balances? Is that, I'm just trying to figure out what, what the fees are.
What the fees are to cover is that those distributions. I don't believe it. Diane would probably know this question. I don't think that there's a specific website that they log onto on the Vanguard side.
We have a pension somewhere.
Yeah.
There's a website and says this is your payment.
Yeah.
This is what you get every month.
Yeah.
Right.
Is Is that $18, is that what everybody pays per year? So it's like
No.
that 18 for what?
It's
Sure.
just determining the fee for pension payroll. No, this is not what the participant pays. This is just what the trust pays.
Mhm.
Right, okay.
Yeah, the reason I was asking it partly was, I had an experience, not at the last employer, I worked for MasterCard, retired from them last year, but a prior employer lost me entirely in the pension plan. And I had stayed at an employer for 5 years just to vest. And I had to go and prove that I had, and they didn't have at the time any way to verify it. I had to like write to the head HR of the company.
Well,
Oh, interesting.
I was curious what information you provide our employees in the town.
We asked, I think it was outsourced shortly before I started,
Uh-huh.
so it was in-house with Diane. And they outsourced us, but I believe it's Tucker and Holcomb who's doing the outsourcing on the pension, so if someone wants to know their number and things like that. They do have a website, I'm not sure if we're on it or not.
Okay, do they get a yearly statement or something like that?
They should
Yeah,
get your
'cause,
statement,
I was
for
thinking
doing
your
the
statement.
data and things like that, they should be getting a statement.
What they best and how much.
Yeah.
Yeah, exactly.
But I'll find out all the
Yeah.
details of the outsourcing.
All right.
Good. Yeah. Need more evidence of that, yes. Okay, Brian.
All right. What I also wanted to show, because it's been about a year or so, and is, okay, what we talked about on the previous page is what the absolute performance is, what was the relative, it's pretty close to the composite benchmark because it's an index portfolio. But there are universes out there, or this is the main universe that we're certainly aware of, to say, well, how say is Vanguard doing against other outsourced chief investment officers? So, and this is data that you could certainly get on the website. It's referred to as the Alpha Nasdaq OCIO index. And so what I looked at is, okay, this is the town of New Canaan's, I should have put, this is the pension plan specifically. This is net of fees. And so the yellow bar is and the time difference is different. There's a lag between when this Alpha Nasdaq data comes out. So this is as of March, wouldn't match the previous pages. So here's the town of New Canaan's performance, the yellow bars as of March, and comparing that to other plans. We don't know who are those other plans. They have to be self-reported by all these other institutions. This is comparing it against a moderate asset allocation index. So let me come back to this page and just give you a little bit more data first. So this moderate allocation index, which I highlighted on this page, these are other plans that are pension plans, and it could be endowments, others that have a risk profile where they're have 31 to 50% what's in risk mitigating asset classes. Think of that as mainly fixed income. So with the town has 35% fixed income, the best comparison universe would be this moderate asset allocation. Let's see. I was hoping to show you all the different firms, but there's probably 20 different firms that report the results of their clients. They never name names. So this is just to give you some basis on what are we comparing against and how is it derived? How many different plans are we comparing against? So say like on a 1-year basis, there's 390 plans that we're comparing against. So, I'd say very positive. The results have been versus peers. So notwithstanding the 1-year performance on a 3-year, a 5-year, 7-year, or 10-year basis, the town of New Canaan's performance, net of fees, has been stronger than this peer universe of similar plans with a similar asset allocation. Just to give some basis. So I think, going back to the other slides, the absolute numbers have been quite strong. And then this is more of a new phenomenon as far as setting up these peer universes. So again, this is something that you could look up, Google Alpha Nasdaq, OCIO universes. You'll be able to see the same data that I have here on page 16, 17, 18, 19. It's kind of all foot marked, but this is what's referred to as, these are all the asset classes that they consider risk mitigating, right? Could be some hedge funds, treasuries, cash, but really think of it as equities versus fixed income. So I just wanted to show that, because sometimes like, well, how are we doing versus others? And then the other measure that we know about is really, I'm going to skip this. I'm going to go straight to page 22. Is like, well, how are we doing on a funded status basis? This is using on page 22 here. This is looking at the other towns and cities in Fairfield County. We do this on an annual basis. I think we've been doing it for 4 or 5 years now. And we say, okay, what are the other towns? What are they using for a discount rate? How much do they have? We call them return seeking. Again, think of that as equities, private equity assets. And then the other ways we've color coded this is like the size of the bubble just means how big the pension plan is, right? So, not surprisingly, like Fairfield or Norwalk, those are bigger plans by assets. And then this is kind of arbitrary. It's kind of like stoplight. But we said, how are these plans less than 90%, 90 to 100%, or 100% funded? So I think the town is doing well in an absolute performance and a relative performance. But then importantly, what matters to the residents is like, how's the funded status? Because that ultimately drives contributions that have to go into the plan. And the funded status still remains at the end of 22 fiscal year, over 100% funded, just barely, but still 100.
Yeah.
Right.
And if you need any of the underlying data, we have it in spreadsheet form. I can get that to all of you, but this is, we're trying to show it graphically.
This,
I think this, actually, we took a good opportunity this year to trim on discount.
yeah,
Yeah, I think that is, that was a very good move. We'll see where we are next year, but that was,
like, you're always gonna benefit from
yeah,
being conservative and just.
right.
Because you don't dig a hole.
Do
Yeah.
no harm. That's
So right prior to that, since you mentioned that, Tom, is okay. So, all right, we have our asset allocation. This is what this page is showing. Here's our target asset allocation to the asset classes. The right-hand side is, here are our forecasts for what we think that those asset classes will do over the next 30 years. We always show a distribution. So, 50th is the median. What's not on here is the correlations that you have to take into consideration when looking at, well, what's the forecasted return for the total portfolio? But what we're forecasting over 30 years, we use the 30-year time horizon because that's what the actuary uses. So we're expecting the towns, based on the current asset allocation, to have a return of 6.64% over the next 30 years. And that's somewhat just, that's basically in line with the current discount that we have of 6.625. So, almost right on top of each other. And I know yeah.
Not for now, but it would be so interesting. Vanguard's been around for a while. How did their projections, how did they fare? Like 20 years ago, if you projected, not for now, but that would just be very interesting. I mean, 30 years is a long time. So, but if they had, I'd just be curious.
Yeah, I could show that with at the next meeting, or if you want me to show it forward earlier, is we show forecasts, like I said, here are forecasts for the asset classes. If I went to page 23, here's just some more sub asset classes, but we do track that and we say, okay, what was our forecast 10 years ago and where did it land? And the most,
It's like an Ed Patch moment, just to date myself. How am I doing?
yes, yeah. So I could show that. I could show that for the major asset classes. I don't know if we have it, specific for the town of New Canaan to recreate that. But we could show how it's done, like how Vanguard's forecasts at the asset class level have done. And even we've done it for a generic 60-40 portfolio. So I'll add that as a takeaway.
Yeah,
I'm a little surprised that the international equities, the volatility isn't much higher than the US. The US equities are only 18.1% and international 18.9, just based on, my own limited investing. I've found that international funds are very volatile. The ups and downs are,
Yeah.
I would have thought it would be a big difference.
It's a fair observation, and I would say that I think I'm pretty sure if we went back a couple of years that
Mhm.
has been wider over time, both historical or forecasted, mainly because part of that non-US equities bucket is emerging markets, right? And certainly that is a more volatile asset class. What may be driving in this, as far as the forward looking at where we are right now, is the valuation dispersion between US and non-US is quite wide. Meaning like when I say valuation, like PE multiples for US markets versus non-US markets. And that's really the big driver of why we're expecting international markets to be about 200 basis points higher than US markets, is really that valuation component. There's a currency component as well. But because of that, Colm, I think that's also driving down the expected volatility. Whereas you're right, it's typically wider or higher for non-US equities.
Okay, thanks. Yes, yeah. Sometimes.
So let's see. I covered really the main topics that Diane and I had discussed, or would be interesting to the RPAC. But I know there's probably a few other topics out there. So
Yeah,
I'm completely fine on time.
yeah, I was just kind of looking at my watch here and thinking that maybe it makes some sense, having gone through all of this, which has been very helpful, obviously, and a good way of setting the content. So we have our investment policy. We have a couple of things here. So just the RPAC numbers here, Brian, you have a copy of the investment policy statement. The town came in. They crafted this or developed this with the assistance of Vanguard. It's a 2017 dated document. There's some pretty good thinking that went into this, to be perfectly honest. When I read it, I don't do this kind of stuff, but it seemed like it, did a fair job of covering the waterfront, reserved the right for us to make changes over time as we got a little bit more sophisticated or experienced with these things. So we have that. Now, there's really two main issues before us to consider. One is a little bit of a housekeeping matter, and the other is more of a forward-looking, what do we want to be when we grow up kind of issue. So let me take the first one first, which is, I believe a recommendation or a comment we received in some of the interactions with the auditors had, kind of stumbled across the fact that our investment policy does not address or limit, shall we say, in any particular way, the use of currency or other derivative type investments. And the recommendation was that for funds such as ourselves, to which the IPS applies, that you would typically find some language that would essentially say you can only do those types of activities to actually hedge or mitigate a specific and actual genuine risk in the portfolio. So if the portfolio was weighted in a way where we had a lot of exposure to a certain type of current companies with revenues that are denominated in certain currencies, or we had, some sort of interest rate risk that was heightened, we could, enter into some things to mitigate those risks as they were assessed and measured, as opposed to speculatively saying, oh, I know if we start doing, options on futures contracts and so, and then all of a sudden, So the thinking is we probably should consider some language, and to that end, there was some language that Diane sent around, that is the one single page.
Mhm.
It's shows up page 14.
Yeah.
I'm not quite certain what she derived this, maybe we can pull it up from her email. But you will see that there's some language here that talked about foreign currency exposure and the use of derivatives, whether it's
Right.
currency derivatives or interest rate derivatives. And so thinking is language along these lines, and frankly, I think these sample provisions here seem to hit it as far as I'm concerned, which is perfectly fine. I don't know if anyone had any thoughts or additional comments on that, but I would think that we should probably seek to put that in, and we would like to put that in time for us to be able to point to those examining authorities at the next opportunity that, oh, by the way, yes, we took the recommendation to heart and we did this.
And this is
Right.
all thoroughly hypothetical, because we don't have none of this right now.
Well, correct.
But if for some reason the policy.
Yeah,
stands, yeah.
I mean, if it's found to be wanting in some way, or the recommendation is you'd be best placed if you could put in that kind of limiting language, I think it seems fine to us. Like you said, I can't conceive of a circumstance where, Brian or the others
No.
would need to take advantage of,
Right.
you know, the provided by this, because we're not doing these kinds of investments anyway. We're kind of more index based.
We're pretty plain and
Yeah,
line.
it's.
Yeah. Well, that was my reaction when reading derivatives, like, I couldn't believe that, you know, we would even think about using, we're as plain vanilla in
Right.
our investing as you could possibly get, so.
But I think it probably is one of those, you know, one of those provisions where seems obvious, but just want to make sure, bears repeating, we're not doing any of this stuff, right? So
Right.
that's really the first housekeeping. The second, although somewhat.
But actually, just wording that the funds managers may use options in future solely in order to reduce the risk. That suggests to me that it could be done.
Right.
I would,
It's a
I
lot.
Well, would only use, or would be exclusively to, or we could say they can't do it at all without coming to us and getting our approval.
yeah, I think.
Does that make some sense?
Yeah, that,
I think it's gonna raise red flags.
yeah,
You're gonna put that in, like, what we're doing, what, you know, I mean,
Well, so then why don't we say, so you see the last sentence says without explicit authorization of the board, they can't do. And then we can just kind of go with that.
who's the board then?
Well, meaning without coming back to us, nobody could do this.
Right, but who is it the chief financial officer of the town?
Right,
no,
or is it
just
the
committee.
I
finance?
think we call it committee, we're gonna be called board, we call it
Okay.
committee.
Yeah,
Yeah,
Okay,
yeah,
this
yeah.
committee, yeah.
That's.
okay.
I think, right, it's more like you're saying, Colin, it's that, you know, any proposed asset allocation that would, you know, propose use of foreign currencies, a separate investment strategy would need to come back to us.
Yeah, I mean, that's kind of what the last sentence in the
Yeah.
derivatives is saying, and the last sentence in the foreign currency, which is,
So put them both in, right?
yeah, just the last sentence, without explicit authorization of the board, no manager will utilize, which they can't do this, that, or the other.
Without, right,
Without, right, that's the lead.
yeah,
And it would be without the explicit
You don't need
authorization of
to-
the art.
you can just lose the rest of the sentence after the parentheses, I think.
Yeah, these were some examples that I had forwarded to Diane, like just I think of that other clients have used. Fairfield being one of them, but I think I don't know if it was the auditor had also pointed out Fairfield, but yes, yeah, it all makes sense.
All right,
But yeah,
so-
you're correct in saying that Vanguard would never, Vanguard would never use it. The funds don't even, like on the international equity side, we don't do currency hedging in the index fund. But they will sometimes use like currency futures, you know, to monetize cash or anything like that. But yeah, the derivatives are never used by the funds or by Vanguard in order to like say generate return or change asset allocation.
Yeah,
It's almost like that last sentence, like no speculative hedging will be permitted.
yeah, I mean, that's basically what we're gonna say, without our authorization, you can't do any of it, just period, full
Right.
stop. We're not
Right.
gonna try to provide
Yeah.
exceptions, we're just gonna leave
Right.
that. I guess the question maybe that's more for Ann and Diane, which we can talk about, and I'll finalize some language.
Okay.
Hard to make that, but we would need to understand how we can formally amend the IPS. And, you know, I just know that Rob Blasey signed this.
Yeah.
Yeah,
Seriously,
it's-
that's what, yeah.
Yeah, well, and I'm not sure why you did, and we are alternatively referred to. It's the town of New Canaan is the sponsor, and the sponsor reserves the right to make any changes. So we would need an appropriate representative of the town to transmit this to Vanguard and get them to sign and acknowledge it, that's all.
And typically, maybe I'm just thinking now, policies, typically all policies go through the board of selectmen to give the first selectman the ability to sign.
Yeah,
Okay.
That's probably the main,
fine, so I'll work with Diane to get that done, but we will, we'll come up with language that basically says they can't do this without coming back to us. Yeah, that sounds fine.
Yeah.
So then the other purpose for having, you know, this relative abundance of investment policy guidelines is there's been a number of discussions that we've had, which I think have been good, about whether and to what extent we might at some future time consider other types of investments, you know, in addition to very conservative index based. And we thought about it, we talked about, it. Brian's had some good, you know, market data points of what other communities and similarly situated funds might consider and what they're doing. You know, and we, you know, we're not in a position that we're trying to make up lost ground or chase yield, but on the other hand, we don't want to be in a position of our own complacency causing us to lose ground. And so, you know, just in connection, however, with that healthy discussion, I think we need to educate ourselves as to what this means, right? So were we to decide, hey, you know, on balance, it now feels like this is right for us. I'm not saying that we're there, personally, I don't think we are, but if we were to say that, what that means, and I believe it's fair to say, and Brian, you can, maybe this would be a good segue for you to jump in with what you know. But were we to do that, the remit of this committee would need to change. Because we would be moving much more closely, if not actually, into the area of actively investing. In which case, we would probably need monthly meetings, we would probably need to perhaps expand it a little bit. We might want to have someone like Todd here, you know what I mean? Just right now, given what we do, the remit and mission statement of what we are aiming for and how we actually conduct and discharge those responsibilities, it seems like it works for now, but if we were to bring in other things, we need to kind of understand how that works and then what an appropriate investment policy statement might be for that construct.
How much exposure, what percent?
Right, exactly. And so you'd be adjusting that all the time. You might even, you know, call unscheduled meetings in the middle of, you know, just kind of saying what's going on. So, and you can imagine what that might do if you did have Silicon Valley Bank or a debt ceiling thing in the middle of that, causing you a little bit of, oh, emergency meeting, let's check it. So maybe Brian, with that as some, you know, awkwardly, hastily put together context, if you could chat with us a little bit about what you see or what you've experienced with other communities that are kind of more on the actively managed end of things and how they conduct their affairs.
And along that line, I'd be curious, what's the time frame that people have been dipping their toes in these alternatives? Is this something that's within the last 5 years?
Yeah.
And do some people have a 10-year track record? Because we have a long track record.
Yeah, no.
And-
Yeah, and it's obviously
And
all to the good.
yeah, and things always look great until they don't.
Right, exactly. It all sounds good.
Right.
until it's-
Yeah.
So, yeah, no, it's a good discussion, and I would say the active management you can define in one of two ways, right? So you could implement active in with active managers, right? You can hire, you know, so say in U.S. equities, you could have J.P. Morgan and Wellington, Lazard. You could be picking actively managed fund managers to do the stock selection, right? That could be whether it's in equities or in fixed income. So you have equity, active equity, or active management at the security level, which we're familiar with. Then there's also active at the plan level, but that's more referred to as tactical asset allocation, right? Do we think small cap is going to outperform And though therefore, I'd be coming to you today and like, okay, let's shift 5% of our total stock into a small cap fund because we think it's going to outperform. So I think of the active management in those two ways, like being tactical with the portfolio, which we're not, here at the town, but also our philosophy is not to do that as well, mainly because we can point to results that have shown that tactical asset management overall has not typically worked for the majority of funds. I won't say for all, but for a majority.
Hey, Brian, in terms of,
Yeah.
groups who might approach more active management, what's the size of their fund? I mean, 153 million is just not that big. I'm not saying it's small, but we're no CalPERS, I mean.
Right.
So it's one thing to have this billions or trillions that you've got a little tiny chunk you're playing with.
Mhm.
First, I mean, 153, that's just not that much.
And when you say active, also, are you talking about tactically moving it or just using an active manager? Meaning like,
Yeah, these guys use active for probably part of their fund, right? They don't.
yeah.
Yes.
Yeah. I don't know if there's really a size that would dictate when using, active versus passive, but there's a lot that can, so tactically moving the portfolio, and I'm glad to show this data, again, that's not within our philosophy because we've shown that to hurt value. And in some ways, you can look at what we're showing with the Alpha NASDAQ universe, right? We have an index portfolio. It's outperformed other peers. There's certainly tactical managers within that universe, so that it's worked. And then, even small plans, smaller than yours, might use an actively managed stock fund or an actively managed bond fund. And that's more of a risk tolerance perspective. One, being comfortable with more volatility, being above and below the benchmark. And then also a question of do we need it, right? So there's some plans, if we just stay in the public space, there's public plans that are underfunded. So you can get there by changing your asset allocation, or you can beat your benchmark by using, active stock selection. So I think the active passive discussion is more along the lines of what's the tolerance of the committee to handle volatility both up and down against a benchmark, and then, you know, do we need to reach for additional return above our benchmark? And I think those are the two big relevant questions that I kind of have with other committees. But I don't necessarily think it's dictated by size. Where the size of a plan that comes more into play is with alternatives. Usually need some size and scale as you're dipping into private equity, certainly private equity, maybe less so private real estate. So I think that's when, you see the big state funds, CalPERS you mentioned, whether it's Connecticut, they typically have larger allocations to alternatives, namely, private equity being the biggest one.
Yeah, and I guess if we think about this, so the size really it more drives some of the decision making after you were to determine that you wanted to do this kind of thing, rather than driving the decision about whether you were going to do it, right?
Yeah, because it comes to the objective, right? And you can hear, you could hear say, well, our objective is to, to be fully funded or to at least get to the discount rate. And so we always come down to the objective of what we're trying to do in the portfolio.
Yeah, but and that all makes sense to me, but then sort of turning to the other point you made, which I think is a good one, which is, this is all going to be driven by need. And I think we've all kind of nodded here to each other. We don't need to be chasing yield. We've done quite well, thank you very much, with some discipline and some, management of the fees and expenses and the index, and so we've done well.
Yeah, and contributions, yeah.
Suggest that we have some cushion, right? All of that makes sense. So the only other factor that feeds into need, and maybe if we can make a note and to get Diane to ask Booker and Holcomb, but I think if we were to get a better, solid understanding of, to your point earlier, how many participants, what's the projection? What is this fund trying to solve for over time?
Yeah.
Because we may find that we're on a point on the spectrum towards like a fully mature plan that not only do we not need it, we want to stay far away from it. Right?
Yeah.
And we're in a good place. It's getting to the point where this is going to be a simple, small level.
Right.
So let's not upset that.
And we need that.
And he would,
We need it when we need
yeah, and so it seems to me that might help clarify. Not only, I don't think this is the right time, or whatever, but it might clarify like, oh no, I'm absolutely certain this isn't the right time. Right, which kind of feels like.
it. Because our horizon is short.
Yeah, so maybe something like that, and we can get, I forget, what's the name that runs the.
Ellen?
Yeah, Ellen, she can maybe speak to that a little bit, and we can get into. Participants, new ones, how many are actually drawing now, who's
Yeah.
paying in, right, all of that actuarial stuff, so that we can just figure out. What are these funds solving for over time, and where do we sit on that spectrum, because that would really be illuminating, I think, for all of us, right?
And the
Right.
question is, do we have an issue?
Yeah, I mean, I would suspect, well, as you know, my view has always been.
Yep.
We sit in an enviable position, we should be doing a lot.
Yeah.
And I think that's all fine, but I do think it is healthy to have these conversations if similarly situated funds are doing this kind of thing.
And do
So,
that.
right, and of course, they might be doing better. I'm not certain we need to do better, but we need to be aware of how and in what manner other, funds and investment committees and RPACs,
Yeah.
how they, actually solve the problem, because you never know, down the road, we might need to do something.
I think when I first
Right.
joined the committee 2 years ago, Michael Chen was on the committee. He was asking the committee consider alternative investments.
Right.
Because of just the opportunity, not that we needed it,
No, of course.
but that, we were very conservative and.
Yeah.
That his perception was that there are, other opportunities that the town could pursue.
Right.
And I think that my perception anyway, I was new to the committee, was that there wasn't that much of an appetite for it to pursue.
Yeah, for sure, those initial conversations with Neil Budnick and others was, we don't think that there is. I think Michael was asking because he was saying, and remember, some of those were really over years, right? We had a lot of, and it's like, is there something that we could do
Yeah.
to prevent us giving this back, right?
Right.
Because if we stay, and we're gonna have to get some of this back, and maybe there's some strategies. And I think at the time, we chatted about it, we said, we don't have that, which I think is a fair description. And so I just think it makes sense for us to be able to report. Not only to Todd and the other, board of finance members, but anyone else that, look, we've had a full and fair discussion of this stuff. We've talked about it, we've looked into it. Given our understanding of where these funds are now, the level of beneficiaries drawing and other participants paying into it and our investments and whatnot. We're not missing anything. We're good where we
I
are.
agree, that's fair.
Yeah, and I think
But
that's.
I think we do need to see how others who have pursued that, how it worked out, right?
Yeah,
Because
because,
that was something, there's some really hot years, right?
Yeah.
And then it was like, it's gonna go down, so we gotta, counterbalance it, but how did those counterbalancings work for people?
And to Tom's point, that it may require more active management by this committee, if this committee were to take that on. And to my mind, it raised all kinds of questions about conflict of interest and how do you choose and, all that type of stuff. that
Right.
I don't feel qualified necessarily.
yeah, no, I think it is, it's true, it's a level of operating complication that we have happily not had to confront so far. And which it seems to me that it would provide a number of challenges. It certainly would raise the fees and expenses,
Yep.
definitely, for
Correct.
sure.
And we're
And,
not broken. So.
right, well, that's right, there's not anything we're really trying to fix, we're just trying to, sort out, well. Where do we in all of this good performance of ours, where do we sit in the context of other similarly situated towns, and what are they
Yeah.
doing?
So I mean, anecdotally, I mean, I don't know how to do it anecdotally. I mean, I could talk about with other plans that I work with here in Fairfield County, and it's a mix, or even outside of Fairfield County, and some have also adopted a passive approach, and some have adopted an active approach in the sense of using active managers in the fund. I don't work with anyone again because of the philosophical basis where we're trying to market time, but I, for instance, work with the town of Fairfield, and when I joined them, they had an all active portfolio and the results weren't so good. And the way we structured it is to be passive in the public markets, but we still have private equity and private real estate exposure. And almost by default, that is active management. So when you have private equity, you can't index private equity. So private equity is basically just the active management, but it's illiquid, excuse me, illiquid. So um, I don't know of any one source to go to get,
Well,
where New Canaan is on the spectrum of active versus passive in the implementation.
let me
And
just ask you
yeah,
this, so for the town of Fairfield, and, if you can't
yeah,
share secrets, I understand, but.
And they're like 3 times the size.
Yes, yeah, and they're,
49,000 people.
and they're well-funded, but not over 100%, I get all that, so.
right.
But, for example, do you know, Brian, is the committee that oversees those investments, is it their, the analog to our full board of finance, or do they have
Yeah.
something, our stuff here?
No, just like you have the RPAC, they have
Yeah.
the JRIB, the Joint Retirement Investment Board. So it's a
Okay.
committee of volunteers. I mean, the CFO sits in the meeting, but it's just like the RPAC. And then we have similar meetings, similar discussions.
And to
And
your meaning that JRIB or whatever, they report to some sort of analog to our board of finance?
uh, they report directly to the Board of Finance, just like we occasionally go down the down the hall. They also have quarterly meetings with the Board of Finance. And I think
Nice.
most towns do, at least here in Connecticut.
So like in Fairfield, which has a portion of it's more active, do they still have quarterly meetings of their version of RPAC? Or do they do
Yeah.
it?
Yeah,
Which
yeah.
is-
We still meet slightly more than quarterly. And I think that was just, I don't know, I think it was a legacy holdover of why they, right now we're meeting 6 times a year. It's, I don't know, it's
Okay.
neither here nor there, but, and we've gone passive on the public side, and I'm not sharing any secrets since all of this is public information, but we still retain private equity and private real estate, and those are actively managed. But on the stock side, or I should say public equities, public fixed income, that's all indexed. And the idea is still keeping some of the alternatives because their funded ratio is somewhere in the mid 80s. And so, the private equity results, private equity they've had for quite some time, and the private equity results have been good.
Yeah.
Hey, this is a bit of a distraction, but do you know, like, so, Connecticut, where they're kind of inching their way up to being a better funded, retirement account and, kind of with the excess funds coming in, do you know, just like, and they're like at 49%, they're getting better, but
Right.
they probably have a portion of theirs in the yieldy or potentially yieldier.
In the state fund?
Yeah. Yeah.
What
I
was the
wonder-
last part? They potentially have what?
See, they to me would be a perfect example of they're big, right? Taking a portion
yeah.
of that and, swinging for the, home run with, the alternate investments.
Oh yeah, they're. I know the state is heavy into alternatives, probably more so than any town. My guess, and it's kind of an educated guess looking at this a couple of years ago, but I would imagine that their alternatives portfolio, private equity, private real estate, hedge funds, private credit, I'm going to say is over 20%. I mean, I would say in the range of 15 to 20, but I could pull that data.
Yeah.
I could pull that data, but yeah, that's kind of reflective of the size, but also where they are from the funded status perspective. And that's what drove so many plans into alternatives, is because they were poorly funded. And you can get that. You have two levers to pull. One is you can increase the overall risk of the portfolio. And one way to do is active management, but also using alternatives, because the forecasted returns are higher than the public markets, but you have to be in the right managers in order to realize those gains. Um, we've had these private equity discussions. You know, if you look at private equity, the median manager in private equity has really done no better than the public markets. It's when you find the great managers, they really outperform. So the dispersion of returns as private equity is huge, and you really have to be with the best managers in order to outperform the public markets.
You also have the issue, you were talking about conflicts of interest, you also have the issue with private equity of what are they doing, and do you want to be associated with them, just for better return?
Right.
Oh, yeah, there's.
Yeah.
Gold mines in South Africa.
Yes, yeah, or worse.
Yeah.
Those are
Right.
natural shots.
Well,
So-
so this is helpful, again,
Yeah.
I think it's worth a conversation, it's a reality check, it's benchmarking in some way. And I do think we should be able to have it so we can say hand on heart when we report back to the Board of Finance that, look, we continue to thrash it out, have the conversation, we're trying to get smarter on this, but we don't see any compelling reason to change what we're doing.
Yeah, just a couple. I just want to reiterate a couple of the things were said. Is yes, Michael was kind of pushing more that way mainly on private equity, just because he's seen a lot of endowments and foundations and doing it, and so we don't have anything against alternatives, and we implement alternatives for some clients. But what you introduce namely with private equity, is less transparency. You have higher fees, and the big thing is a lot less liquidity. Usually, you have to lock up your capital with those commitments, 12, 14 years. So it does reduce volatility kind of in the short term. We try to model this because, like last year, there was no markdowns from private equity investments. So public markets were down 18%. If you had private equity in your portfolio, you were kind of flat, right? So it gave you that diversification. But what's happening now in 2023 is eventually you have to take some markdowns on those private investments. You're not marking them to market every day. And so
Right.
now you're starting some markdowns in private equity.
It's sitting in commercial real estate right
Yeah.
now.
Yeah.
But
But
not as transparent, that's for sure.
and then lastly, I'm glad to talk more about active equity or active fixed income. And we haven't chosen to use it here, but we can implement it for any town, and we do it with our clients. And sometimes people don't know, but Vanguard has over $1 trillion in active management, and we sub-advise that out. So our active equity funds or our active fixed income or our private equity partner, we hire a manager to run that money for Vanguard. It's called the Vanguard US Growth Fund, but it's managed by Bailey Gifford and Lazard. And the reason we do that is that so we can and we do bring outside managers to clients, but the reason why we white label it the Vanguard US Growth Fund is because we get the fees much lower than anyone else can get them for. So Wellington or Lazard is happy to be a manager for Vanguard because just like that, they have billions of dollars and they only have to service one client, not 100 pension plans to get that same level of assets. So we white label everything in order to drive down the cost of those active funds.
There's still substantially higher fees than what we've got.
Yes. Our fees are,
Absolutely. Yeah. So
earning your money, I'm telling you,
Yeah.
you're earning your money, Brad.
yeah, so I don't have to go into it now just to be respectful of your time, but I did put it into the presentation is kind of how we think of, when do we use Vanguard funds? When do we use external management? And, I listed, say on page 29 or 30, these are all the different outside managers that we use. We have, 25 different managers that will sub-advise assets out to.
Okay.
Perfect.
And then the cost factor, yeah, so Colm, I think you were saying, of course, cost. So any active management is going to be many times more expensive than the passive management, which I showed on that fee page earlier. But this is what we're talking about. Like, so Vanguard's active equity expense ratio is about 24 basis points. And that's, that's lower than 99% of the other active equity funds. So I did put some information about active management in here and the different managers we use, et cetera.
Yeah, well, and to your point, where you were mentioning the illiquidity of some of these alternative investments, again, that could become significant consideration when we get greater detail about what is the maturity of the plan, what are the. So when you start opening, that might actually be the third rail investment policy, right? You don't want to touch that. So, well, look, Brian, this has been very, very helpful as always. Appreciate the thought that goes into the materials, appreciate your time. I will get with Diane, we'll try to figure out when it makes sense for us to bring you back next time, but we are gonna get some more of the information from Ellen and Hooker and Holcomb, and then maybe share that with you and come up with a couple we would like you to maybe weigh in on as we try to assess, well, where are we? What does that really mean? And how does that translate into our responsibilities, right?
Yes.
I guess then, so just in terms of wrapping up, so do I have the RPAC's authority for me to work with Diane and get the final language?
Absolutely.
That just says we
Want
can't
to look at anything like
right,
that.
we can't do X. So that will be fine. We'll go ahead and do that and we'll finalize that. And then some of these takeaways, I'll work with Diane and with your notes. We'll get some minutes. We will get with Ellen. And then when we get that further information from Hooker, we'll certainly send that along, Brian. And then we'll also try to figure out when it might make sense to get you back in front of the Board of Finance again to chat.
Yes, I'm always glad to come back up in person, and I have a couple of follow up items too. But yeah, no, good to see you virtually, and look forward to getting back up there in person. Yeah.
Thanks again, Brian.
Thank you, Brian.
Okay.
Have a great evening.
Meeting adjourned.
Motion to adjourn.
Who's making the motion?
And a second at the same time.
Doesn't matter. It's all part of the lady.
Meeting adjourned. Thanks again, Brian.
Thanks. Thank you. Good night.
Good night.